Have you ever had the unsettling feeling that your inheritance is slowly disappearing? You're not alone. In California, high property values and complex trusts create many opportunities for funds to go missing. Today, we're going to talk about the most powerful investigative tool available to you under the California Probate Code, the formal trust accounting. Inheritance rarely just vanishes. It's usually diverted. Sometimes it's direct theft, a trustee selling a home and pocketing the proceeds. Other times, it's subtle siphoning, charging the trust for personal travel, excessive admin fees, or loans that are never intended to be paid back. And then there is undue influence, where a caretaker or family member pressures a loved one to change the trust at the last minute. This accounts for over 30% of trust contests. A trust accounting isn't just a simple balance sheet. Under Probate Code 16063, it is a comprehensive financial narrative of every penny. It begins with the value of every asset on the day the trustor passed away. If an account was there then but isn't there now, the trustee has some explaining to do. The first red flag is unknown disbursements. The accounting must list every single payment. If money went to a contractor for work never done, we'll find it. Second, asset discrepancies. If a bank account or a piece of property was in the original trust but is missing from the accounting, that's a major warning sign. Third is self-dealing. Trustees are strictly forbidden from using trust assets for their own benefit, like selling trust property to themselves at a discount. Fourth, excessive fees. Trustees are entitled to reasonable compensation, but it must be clearly calculated. Hidden fees are a common way for an inheritance to shrink. Finally, negligence. If a trustee left millions in a non-interest account for years, they may have violated the Uniform Prudent Investor Act. If a trustee refuses to account, we have legal hammers. Under the law, they must provide an accounting at least annually for irrevocable trusts. If they won't, we can petition the court under Section 17,000 to compel them. Once the judge orders it, they have nowhere left to hide. But you must act quickly. Once you receive a Notice of Trust Administration, you typically have only 120 days to contest the trust. If you miss this window, you could be permanently barred from making a claim, even if we find evidence of fraud later on. Time is your enemy. If we find a breach of duty, we can ask for a surcharge. This means the court orders the trustee to pay the trust back from their own personal pockets. In cases of bad faith or civil theft, California law allows us to recover twice the value of the stolen property. This is a powerful deterrent. We can also petition to have the trustee removed entirely. Management failure, even if minor, can be grounds for removal under Section 15642. In my firm, we take a forensic approach. We work with specialized accountants to trace off-book accounts, liquidated investments, and even cryptocurrency. Sometimes the issue is a lost trust. If paperwork is messy, we use tools like Hegstad petitions to confirm that assets belong in the trust, not in probate. As a beneficiary, you have specific rights. You have the right to a copy of the trust document and the right to demand a formal accounting. Once you make a written request, the trustee generally has 60 days to provide that accounting. If they ignore you, the court assumes the worst. You also have the right to object to specific line items, like unexplained attorney fees or travel expenses that shouldn't be charged to the trust. We can even petition to freeze the trust assets while our investigation is pending, ensuring that no more money disappears while we work. A typical trust litigation case in Southern California can take 12 to 18 months. The sooner we start, the better chance we have at recovery. California has also strengthened laws against care custodians who marry dependent adults at the end of life, triggering a heavy legal presumption of fraud. The most important thing to remember is that in California, assets always leave a paper trail. If the money is gone, the trustee must document why. Silence is not a defense for a trustee. They have a fiduciary duty to you. When they breach that duty, the law is on your side to make it right. Waiting only gives a bad trustee more time to spend your inheritance. The investigation needs to start the moment you suspect something is wrong. Our investigation doesn't stop until we account for every dollar. We look at the records the trustee wants to hide, and we bring them into the light. With nearly 40 years of experience in California trust litigation, I've seen every trick in the book, and I know exactly how to counter them. This isn't just about money, it's about protecting your loved one's legacy and ensuring their final wishes are actually carried out. We use a total law firm approach, combining legal expertise with forensic financial analysis to build an airtight case for the courtroom. Whether it's misappropriation, subtle siphoning, or undue influence, we have the experience to identify the theft and the tools to recover the assets. From surcharge actions and double damages to trustee removal, we pursue every legal avenue to restore what was taken from you. Don't let your inheritance disappear in silence. Demand the accounting you are entitled to and hold the trustee accountable for their actions. If you suspect that assets are missing from a trust, you need to act now. Call us now at 888-888-6582. We can help you navigate the complexities of California trust law and fight to recover your inheritance. Call us now at 888-888-6582. I'm Vince Davis, and we are all in this together.